Hi there, Serial Trader here. Let's check in with the major US indices. Alright, so nothing substantial happened today, although after hours there's certainly been some action with Netflix tanking, and it appears Amazon is also showing some weakness after hours. And those are two pretty significant large cap stocks, especially Amazon, as far as market cap goes. So that may be a precursor to what we might expect for tomorrow. But here, just looking at the short-term wave chart of SPX, so a couple scenarios. We either have our 1, 2, 3, 4, 5 up, in this small degree in place, and now we're going to be working, potentially some sort of three-wave decline, right? And what degree am I looking for here? Yeah, that should be fine. So we're either looking for something like this, okay, or we just have, and really this is just, it's going to have similar implications, but just slightly different labeling. Or, okay, we have our 1, 2, 3, 4, 5 of this 3, okay, and we still need, a 4, 5 before this larger, yet small degree impulse is complete. And if I just show the subdivisions of this potential extended wave 3, and let me just get the degree down, one below that, subminuet. Okay, so this is a distinct possibility here, okay, but really it has similar implications under either scenario. Let me just get rid of the magnet since it's snapping where I don't want it to. Okay. So under this scenario, we still would require perhaps a smaller corrective pullback, maybe something like that, and then that degree would be a smaller degree than that, and then we'd come up in this fifth wave. But either way, looks like we've peaked out here short term, and we're going to be working some sort of decline before we can look for another wave to the upside on this time frame. Okay, so we'll be watching for that, and I would almost expect weakness tomorrow with what we're seeing after hours and on the futures, etc. And okay, let's go to the candlestick chart. So here's SPX, and here's that resistance line I've drawn from the March high there, and really we just poked above it a couple times, but you can see so far rejecting off it. They're definitely not breaking out above it like some may have expected or hoped for. But we're still above the T line and the 3T line, so nothing dramatic yet as far as a candlestick reversal signal. But certainly we're just pausing at this resistance level. So no high confidence plays here, in my opinion. We're either going to have a nice pullback before we can start going to actually break out above, or we're just going to pause here and then break out soon. But right now you don't know, so I wouldn't take any aggressive action until it shows its cards, right? Just going a little closer so you can see that. Just kind of a couple doji style days, right? Fairly large upper and lower shadows, small real bodies. And certainly that oscillator overbought, and we haven't truly broken out, so maybe that is a good tell there that we're overbought and needing to come down here, at least short term. Now, Dow Jones Industrial Average, surprisingly, was actually a leader today. It actually closed higher, outperformed the S&P and the NASDAQ, which is unusual. But perhaps some sector rotation. I know the financials had a pretty strong day despite a lot of other areas of the market not having a good day. And the Dow is showing that here as well, and still well above the T line and the 3T line, but in the overbought condition on the oscillator, and nowhere near getting above its resistance level. So if the other indexes have a setback of some sort, I would very much expect the Dow to do the same. Okay, now the NASDAQ. This NASDAQ seems to be the first mover whenever it's either to the upside or the downside. In this case, maybe to the downside. Now we have our potential, mature 5 waves up out of this triangle. So that's definitely saying, hey, be careful, you might have a big pullback soon. And we're in the overbought condition on the NASDAQ. Just made a new all-time high, but had a doji star day. Now today, we actually technically had a bearish engulfing. Okay, because we opened higher than this doji star closed, and closed lower clearly. So a doji followed by a bearish engulfing in the overbought condition. Definitely, that should be some warning flags for you. Okay, that at the very minimum, we're gonna have a little pullback, maybe back down to the T line, or maybe deeper than that. But at the very minimum, expect some near-term weakness according to this signal. Okay, and hey, maybe that was the all-time high, and we're getting ready for a big dump. Obviously, there's no way of knowing that at this point, but just be aware of it. When do markets peak and roll over? Well, difficult to time, but visually, once you have a move like a triangle, which precedes the final move in a sequence, according to the wave principle, and then you have a clear 5 waves up out of the triangle, okay, and within that 5 wave up, the final 5th wave itself also subdivides into 1, 2, 3, 4, 5. Maybe you need one last 4 or 5 to complete the sequence, but looking very mature, okay? Very mature at the upside. Now we got a candlestick reversal signal. We have, some big stocks tanking after hours. So just a caution sign here. I'm not saying, hey, short the market down into the ground. There may come a time for that, but right now, just caution, warning flag. Okay, now the VIX. Now I've actually done something with the VIX, and I'll show you what I mean. So VIX was near the bottom of its range, and any kind of short-term pullback in the equities, I believe VIX will probably move to its upper end of the recent range it's been in, which is quite a move in VIX. You're looking at a move from the 12s to potentially, the 16s, or even almost 20, 18 to 20. So percentage-wise, that's a large move on VIX. And I've actually taken a position with that in mind. So I bought 50 VIX calls. Okay, I bought the 10 strike, and they're the 15th of August expiration. And I paid a net price of them of $4.10 per share per contract. And if you just look at the VIX option chain here, so the reason I picked the ones I did, so 10 is the lowest strike available, and at this point it's a significantly in the money call. So most of the value of this call is actually intrinsic, because right now VIX is at 1283 and the strike is 10, so 283 of the 410 that you paid, if nothing else changes in VIX, if it just literally remains where it is at expiration, that value still stands. So you're not giving up too much as far as time value. And obviously, the farther you go out of the money on VIX, the implied volatility of volatility itself goes up a lot, because the option market prices in the potential for a huge move up, even though it's unlikely. When it does happen, it's very fast, and that's why you have to pay a lot more to get those out of the money options, since they do have ridiculous potential should things materialize, however unlikely it may be at any given time. So okay, let's say VIX moves up, right up to 18, let's say, just kind of knocking on top of this short-term range it's been in. How would that position perform? So I paid $20,500 for the 50 calls, so that's the maximum risk. Although not really a maximum risk, because VIX can't really get below, around 12 right now. So that would still basically practically only, there's theoretical risk and there's practical risk. You'd only be practically risking around half of the actual total position, right? But okay, let's say VIX gets to 18 anytime, now or anytime at expiration. You're looking between, if it happened at expiration, which is a while from now, about a month, you'd be looking at a $19,000 gain, okay, at around 18 on VIX. If it got there right now, you'd be looking at a $27,000 gain, okay? So that shows you, you could easily double or more your money on a relatively modest move up in VIX in the next 30 days, which, given where everything is, kind of looking overbought short term, and I think it's quite a reasonable expectation that could play out, and not a ridiculous risk either. It's quite reasonable risk, and actually, I may convert to a spread since the implied volatility is so high on these higher strike calls. If I get just a bit of a pop in VIX, maybe sell, sell 50 calls against the long 50 calls, and maybe either greatly reduce or even completely eliminate the risk of the original position and still allow, a doubling to take place or something like that. That's a nice scenario to be in, and it could very well play out like that. Now, let's say VIX actually has a pretty decent move up and we get a real nasty pullback. Not devastating, not a 50 VIX event, but let's say back up to this secondary level of resistance. Say we get to 25 on VIX in the next 30 days. Well, where does that take our position there? Well, now we're looking at, so right now, that'd be a $65,000 gain, roughly. And an expiration would be a $54,000 gain. So I think it's a pretty reasonable position to take given the current market conditions and just being the volatility was in the lower end of its range. Certainly not a guaranteed winner, and nothing is, but I think it's a prudent position to have right now, actually. And you're not really it's nice in the sense that you could just have a relatively minor pullback. Nothing that would really be, amazingly profitable if you were to be buying puts on SPY or something, or SPX. And yet, that relatively minor pullback could easily, produce a double on those VIX calls. So that's how I'm playing it. Just thought I'd bring that up since I did it. That's my position. All right, well, we'll certainly be checking in throughout the week. Could be an interesting week. All right, Serial Trader signing off.